meeting, so maybe we can start. And in the meantime, the others can come. As I've already written in the chat, we will start with illustration 10 in the cash flow statement preparation, tutorial 2, and then we'll continue with illustration 11. Okay, so this is like the plan for this tutorial session this afternoon. We are going to focus only on cash flow statement. We actually covered some a little bit shorter exercises in the first tutorial, learning how to calculate various amounts that will be included in the cash flow statement. But also we showed during the lecture how to prepare full cash flow statement. So starting from the beginning, the cash flows from operating activities under both methods, direct and indirect method. In this tutorial, we are going to show how to prepare a full cash flow statement under the two methods, and we are going to do that twice with two different illustrations. Please, just don't let me continue when you don't understand something, what's going on, how we calculated any figure. As long as we do not have these tutorials recorded, please make sure you ask in the right time, okay? So I'm starting with the illustration 10. It's the same data that you already have in the tutorial, but I have put them in the Excel file, so it's easier for us to cover that in this way over here. So what we know is that the first thing before starting to prepare a cash flow statement is to read very carefully through the information we have, because everything that we see there in the statement of financial position that has changed from the beginning to the end of the period will have its impact in the cash flow statement later, okay? So make sure you understand what's going on, and when necessary, make sure to make the necessary calculations in the right time. For example, we can see that the property, plant and equipment and development expenditure, they both have changed from beginning to the end of the period, and please try to remember that this will have an impact on the investing activities in cash flow statement. Then we have the current assets section. Both inventory and trade receivables, they will be included in the cash operating flows, whereas the cash and cash equivalent, the way that this item is changed, will become the total of the cash flow statement itself. Next, what we see are the items under equity and liabilities. You see the equity items that we have here: share capital, share premium account, revaluation reserve, retained earnings. All of them have changed, and this will bring their impact in the cash flows from financing activity in the cash flow statement. Keep that in mind. Whereas non-current liabilities as well will have an impact, most probably in the cash flows from financing, except for deferred taxes. Remember that IAS 7 requires the deferred taxation as well as payable taxes to be included under the cash flows from operating activities. Okay, then we have current liabilities, trade payables, income taxes, accrued expenses. Most likely they will be part of the cash flows from operating activities. Next, we have information on the statement of profit and loss and other comprehensive income. We have the revenue, we have the cost of sales. What we know is that they represent the main items which in the direct method will be converted to cash inflows and cash outflows specifically. Then we have other expenditure, those related to the distribution and administrative. Then we have finance costs. Another manner how to recognize this is interest expenses, okay? Profit before taxes, another expenditure item, that is a tax expenditure and profit of the year. We also usually have some further information, and we read that very carefully, and in case we need or we can make any calculation, we can do that now because it will be helpful later. For example, the first information that we have is in April 2004, the company issued 1,400,000 ordinary shares. They had a market value or a nominal value or a nominal price, $0.5, and they were issued at a premium at 50%. That means that the issue price in the market is 50% higher than the nominal or the face price that these ordinary shares have. So proceedings from issuing the shares will be equal. I can calculate that exactly in this moment, and that will be something helpful later when I prepare the cash flows from financing activities. This is a ready figure that I have calculated in this moment, okay? So let's calculate how much do we receive, how large are the proceedings from issuing this amount of shares. Again, we have issued 1,400,000 shares. Their face value, their face price is $0.5, but they are issued at a price 50% higher than this face value that they have. So multiplied by 50%. Okay, I don't know if that is clear. What we are doing is that whenever we read some information that we can make a calculation over there that would be helpful later, let's do it right in that moment. We are issuing some shares, exactly 1,400,000 shares, at a price that is 50% higher than their normal price, nominal value. That is 50%. If we make the calculations right now, I'm using the Excel formula, multiplied, by 0.5, multiplied by 0.5, we'll have, we'll have this amount of income from having received or from having the issue of the shares right now. Any question? At least any question related to the proceedings of shares? Something that maybe we need to clarify right now? Okay. Okay, the second information, in May, the company purchased and canceled all its 10% loan notes at par value. Now, let's go back to the statement of financial position. We have here the 10% loan notes, and we can see that actually they are not around anymore at the end of 2005. We start in the beginning of the period with a value of 1,000, and they are not anymore in the statement of financial position by the end of the period. That means that the company has repaid these loan notes. And the information is that the repayment has happened at par value. That means that I have repaid back the same value that they have in the books of accounting for me. That means I can add an information over there. Repayment of loan, 10% loan, is equal with $1 million because all the amounts are in thousands. So every time we read an information, we can make all the calculations necessary right in this moment, so it will be easier later. Okay, another information is the non-current assets include revaluations upward, so that's a surplus or revaluation in upward tendency of property, plant, and equipment by $125,000 during the year. But also non-current assets involve assets that are disposed during the period having a net book value, maybe this should be easier like that, net book value of $75,000. We are receiving on the disposal $98,000. Now, something else that we can add here is that any gain or losses on disposal of these assets have been included at the item cost of sales. Okay, let's see if we have. Okay. Two questions. Why we subtracted 350,000, which is the result? So both your questions, let me understand, are relate to the first one, right? Okay, maybe this will become okay. So what we are doing now, maybe you can, it's easier to understand if we say multiplied by 150%. That is because we have issued the ordinary shares at a premium of 50%. Issuing at a premium of 50%, that means that the issue price is 50% higher than face value price. And face value price is $0.5. So again, issue price is 50% higher than 0.5. Okay? Let's make some other calculations. Maybe that would be more helpful for you. That means that the issue price is 0.5 multiplied by 50%, and if I'm not mistaken, that would be 0.75. That would be the new issue price of the shares, would be $0.75 per share. Okay, so this is the premium, 0.25. The normal price is 0.5 plus the premium of 50%, 0.25. The issue price of these shares is $0.75 per share, which means that when we issue 1,400,000 shares, we collect or we receive how much money? 1,400,000 shares multiplied by $0.75 per share. And if you make the calculations, you will find that we receive 1,050,000. Reply to Adela. Yes, Adela, thank you very much. It's 150%. I'm not sure. It shouldn't be yes. It should be 150%. I corrected that. Adela, over here, it is already corrected. Thank you very much for bringing that to my attention. Actually, in the formula, if you see, I applied 150%, 1.5, but by a common mistake, I wrote it only 50%. What we are adding to our information, dear students, I'm putting in italics, and probably I will also apply a different color to that, so that we know this is added during the discussion. The additional information, only the information is over here. What we are adding and calculating based on that information, I'm putting in italics amount and also with a light blue color, okay? So again, non-current assets includes the revaluation. For the moment, I cannot use that information. Let's go on with the other things over here. The non-current assets that are disposed during the period have a net book value of the amount there, and we are receiving some cash from the disposal that is equal with $98,000. Okay, so we can calculate what based from this? Something that we have recognized as gain on sale of fixed assets or non-current assets. They are the same thing. We have told you that whenever we receive more money that is the value or what is this asset worth to our accounting books, we have a gain. And if the situation would be different, in case we received less money than the net book value, we would have a loss. In this case, it's obvious we are having a gain because we are receiving $98,000, which is more than the net book value, and therefore we have a gain. Gain on sales of fixed asset is the difference between cash received on disposal, market price of fixed asset, another way to say cash received on disposal, less the net book value. That is, the gain on sale of this fixed asset is $98,000, less $75,000. Okay, this is equal to $23,000, the gain on sale of this fixed asset. Again, remember that this gain will be or has been included, as a matter of fact, under the cost of sales. What did we say about the gain on sale of fixed assets? Remember, they are non-monetary items. Remember once again, like depreciation or upward values of revaluation reserves. Also, the gain on sale of fixed assets, remember they are non-monetary items. Therefore, they are included somewhere there, but we have to keep that in mind when we prepare the cash flow statement. Okay, let's continue with other data. Over here, cost of sales also include amortization. Remember again, amortization of the development expenditure is non-cash item. We will use that to adjust in the right moment. Depreciation expenditure is 720,000. Again, we will use that when the time comes. To keep in mind, depreciation, amortization, gain on sale of fixed assets, and so on, they are all non-monetary items. The accrued expenses balance includes interest payable. Okay, let's go back. Now, what we are said is that these accrued expenses over here include several items, and one of them is interest expenditure. Okay, so again, accrued expenses may have interest, may have rent, may have electricity bills, several items. One of the items included in the accrued expenses, that is payable expenses because they are part of the liabilities, is the interest expenditure. Something else to keep in mind when the times come to calculate what is needed there. The income tax expenses for year 2005 is made up on these items: corporate income tax and deferred tax. Okay, so we have two items included in the tax expenses. Now let's get back to the statement of financial position. Okay, you can see here that we have two lines of items of taxes as well. We have one item, deferred tax, under non-current liabilities, and one item, income tax, as well, under current liabilities. So both of them, this one and this one, will be taken into account when we calculate the taxes paid. So again, this company does not have only one kind of taxes, which is the current period taxes, but also has some deferred taxation related to periods in the future years to come. We have to take them into account, both of them, when we calculate the amount of taxes paid. So far, so good. Any question regarding the information that is provided? Something that you don't understand? We are also given an information about the dividends, and we are said that the dividends paid during the year are $100,000. Sometimes we need to calculate the dividends because it is not provided for us, but some other times you see that it is there. No need to calculate that. Any questions so far? Something that you want to know before we continue? Okay, thank you very much, Ivan. Yes, that is true. I've written a very long value. Please, whenever I make some mistake because I'm trying to work again with a keyboard that it's not very good, please remind me in time. Thank you very much, Ivan and the others. Whenever I make a mistake, please remind me in time so it will be clear for the others and no mistake or no misunderstanding is involved. Any other questions? Something else that you need to know before we continue? I would start with the direct method. Now, the direct method is the easiest, if I could say that. Under the direct method, actually what we do is that we start with the items of the profit and loss income statement and we convert them into actual cash outflows and cash inflows. So under the direct method for the statement of cash flows, I would start with cash flows from operating activities. Okay, so this is like the first section of the cash flow statement. You can leave many rows blank because this is a very long section. Then we will complete the cash flows from investing activities. Whatever is that it goes there, we will include in the right place. And the last section is cash flows from financing activities. So this is what we are trying to calculate or to complete right now. Cash flows from operating activities. What do we do under the direct method, if you remember? In the direct method, we take each item of the income statement and we clear that item from the accrual accounting effects. That is, for every item in the income statement, we check the related items in the statement of financial position to add usually the opening balance and to deduct the closing balance. For example, what I'm trying to say here, the first item under the cash flows from operating activities is usually cash received from customers, right? Actually, cash received from customers, it is nothing else that sales revenue, as we know from income statement, plus opening balance of accounts receivable. Is that all right if I just write AR for accounts receivable? It's like an abbreviation that would become very handy to proceed a little bit faster. So plus opening balance of account receivable less closing balance of account receivable. So again, this is like the formula that we are going to use in order to calculate the amount of cash received from customers. Okay, any questions so far? Good, no question, just confirmation. Thank you. So again, we start item by item. What we have in the income statement, we take that and we convert into a cash outflow or a cash inflow. In this case, this is a cash inflow. This means that it will be with a plus sign. Cash received from customers. Okay, let's calculate the cash received from customers over here. Let's start with the sales revenue. That is the amount of sales revenue, 7,500,000. We will work with thousands, amounts in thousands. So plus the opening balance of the trade receivables over here, or accounts receivable, is the same, less the closing balance of trade receivables. If we are quite right, the cash received from customers will be $7,405. So in this way, we calculated the cash received from customers. The most complicated item in the direct method is the cash paid to suppliers, because it involves, as we said, many items. We start with cost of goods sold from the income statement, and what we do. The first thing that we do over here is to convert the cost of sales into purchases using the inventory equation. That is, we add the closing balance of inventory and we deduct the opening balance of inventory. Again, inside these brackets over here, what we have done is that we have calculated the purchases of inventory. Do not write anything because this is not necessary. Remember the inventory equation. It's a basic equation in accounting. And this inventory equation says that opening balance of inventory plus purchases is equal with closing balance of inventory plus cost of goods sold. Now, this equation is what we are using here to calculate the purchases. Again, purchases will be equal from altering mathematically this formula to take into account and to represent purchases only. You see that purchases are equal with what? Cost of goods sold plus closing balance inventory less the opening balance inventory. Okay? So this was just to clarify why in this first brackets over here we just calculate the purchases amount. Okay? But we also need to calculate what we have paid to our suppliers, and That means that we have to adjust the purchases amount with the liabilities towards our suppliers. That means that we will add the opening balance of account payable. Again, I'm using AP as an abbreviation for accounts payable or trade payables. Okay, write that down. So plus opening balance of account payable less closing balance of account payable. Okay, so in this case, let me just make it a little bit clearer to understand. In this manner, we have it more easier, it's easier for us to calculate the cash paid to suppliers. So again, we start by calculating the amount of purchases of inventory, and then we add to the purchases the opening balance of trade payables, our liability to our suppliers, and then we deduct the closing balance of account payables as well. Remember, always remember that whatever is the non-monetary item or non-monetary expenses that is included in the cost of sales should be adjusted here. And I am plus or minus adjustments for non-monetary items. Remember that we have several non-monetary items in this case. And if we go back to the additional information, remember that at least we have included as non-monetary in the cost of sale 3 items. The gain on sale of fixed assets, we have included the depreciation, and we have included also the amortization over here. So these 3 items that are included in the cost of sales should be taken into account as the adjustments for non-monetary items over here. Okay? Should I make a clarification in the brackets? Or yes, I can do that. What are plus or minus adjustments for non-monetary items in this case? We should add back the gain on sale of fixed assets, and we should deduct 2 items: less depreciation, less amortization. Okay, so this is what we need to do. This is what we need to do in order to be able to calculate correctly the cash paid to supplier. So we start with the amount of cost of goods sold over here. I have not represented cost of sales with a minus, so I'm just taking this information and later I will correct for the sign, okay? So we correct or we calculate first of all the purchases by adding the closing balance of inventory and subtracting the opening balance. Later we add the trade payables opening and we deduct trade payables closing. And then what we do? We add the gain on sale. Remember that the gain on sale was like 23, if I'm not wrong. We deduct the expenditure, the depreciation expenditure. Now remember, the depreciation expenditure was 720 and the amortization was 80,000 altogether, minus 700 minus 80. So this is the amount we have to correct for the sign still. This is the amount that we need to take into consideration for the cash paid to suppliers. So again, this is the most complicated item to calculate. We start with cost of goods sold and we regulate the balance by adding. Okay. I think that I lost the first one, which is the cost of sales. And then we add this amount over here. Again, we start with the cost of goods sold. Then we add the closing balance of inventory and deduct the opening balance. We do this in order to calculate the purchases of inventory. Then we make the adjustments needed and related to the trade payables. And then we take into consideration the adjustments related to non-monetary items. That's why we took so much time to read very carefully through this additional information, and we saw that included in cost of sales, there were three different non-monetary items. The gain on sale of fixed assets, because it is said here that any gain or loss on disposal is included in the in the cost of sales, as you see, and also depreciation and amortization. Be careful. We also have a revaluation somewhere. Here we have a revaluation, but that is going to be included in the revaluation reserve and other comprehensive income. That is an item right at the bottom of the income statement. Revaluation reserve, we mentioned in class, is not part of cost of sales. It's not a realized expenditure like the gain or loss on sale of fixed asset or depreciation or amortization. So even though you have some revaluation which is non-monetary, it is not part of cost of sales. Now we are making the necessary adjustments only for those items included in cost of sales. Please let me know. Did you get what we are trying to say over here, or is it necessary for me to explain again? Should I explain again how we calculated the amount of cash paid to suppliers, or is that clear? Elisa, do I need to go again, or was it clear for you? I'm not getting very well. Do I need to go over again to explain again? Again, okay. For Elisa and for the others that maybe have not understood but are not writing, let's go again through the calculations, through the calculations of cash paid to suppliers. Remember, the formula is over here, always. We start with the cost of goods sold. So, again, what we are doing in the direct method, we are going to take the items one by one. All the revenues, all the expenditure, and we take one and then we convert in a cash inflow or outflow. It depends on what it is. The revenues are converted in a cash inflow. The cost of sales will be converted to a cash outflow. That is, not how large is the cost of sales, but exactly how much money did I pay to the suppliers. Okay? So in order to calculate the money paid to the suppliers, we start cost of sales and we adjust the balance of cost of sales with at least two items from statement of financial position. The first item that I need to do the adjustment for has to do with inventory. Why? Keep in mind the inventory equation. You have learned this equation in the opening course, pre-accounting course. The inventory equation is something like a theorem in mathematics. It should always be true. That is, the opening balance in inventory plus purchases should always be equal with closing balance of inventory plus cost of goods sold. Now, based on this inventory equation, we are interested in this case not to calculate cost of goods sold. That is what we already have in the income statement. What I need to calculate over here is the purchases amount. That means that purchases are equal by altering mathematically the formula. Nothing too complicated about that, I hope. Purchases will be equal with cost of goods sold plus closing inventory less opening inventory. So this is how we calculate the purchases of inventory. Again, this is not purchases of plants or machinery or equipment. This is purchases of inventory. We start with cost of goods sold, we add the closing inventory, and we deduct the opening one balance. Why? Because this is the inventory equation. Remember that, write that down. That is something very important in accounting. We use that for several purposes. in T accounts, accounting entry, and so on. And one of the uses is here in the cash flow statement, okay? So we calculate the purchases by adjusting the cost of sales with the closing and opening inventory, like we have done here. You see the first part of the formula inside the brackets represent the purchases. What part of purchases have I actually paid for? To calculate the payments of these purchases, we refer to the opening and closing balances right now of the account payables, of the trade payables. Have I paid all my liabilities to the suppliers or not? We add the opening balance because this is our accumulated liability from the previous period. Okay, and we deduct the closing balance, we subtract minus, because this represents a liability that I have not paid during this period. I will pay later. Remember, I'm calculating money paid. Closing balance of account payable represent money that will be paid later. I'm calculating what I've paid now. And this is why we add the opening balance, that is liabilities from before, and we deduct the closing balance, that is liabilities that will be settled in the future. Okay? So up to this moment, we have calculated purchases and the part of purchases that we actually have paid to our suppliers. But keep in mind that sometimes this item, cost of sales, includes some non-monetary items that should be taken into account right now. They are non-monetary, that is, they do not impact the cash balance, and I have to regulate, I have to adjust for this amount. For example, we have included in the cost of goods sold the gain on sale of fixed asset. That's why it is a plus over there. Because we have calculated this as a gain, but this is not a cash income. This is not a cash inflow. Also, we deduct depreciation because we have not actually paid any depreciation. So I should not include that in my payments. The same thing with amortization. We are not actually paying any amortization over there. After we do all the adjustments, we are left with this figure over here. Again, I used Excel formulas, very easy to manage. You have, in case you don't know how to use Excel very well, you have to learn it because it's very helpful for the work in finance and accounting. So we calculate cash paid to supplier. Remember, it's the most complicated item in the direct method because it involves a lot of adjustments. But we start from cost of sales. We refer to inventory and trade payable to the statement of financial position, plus closing balance of inventory less opening balance. This is the contrary of other adjustments, and that is why I took time to explain why we add the closing balance and we deduct the opening balance. Like it is different from the other adjustments. Usually the other adjustments would add the opening balance, for example, account receivable or account payable. They add the opening balance and deduct the closing balance of account payable. And please remember, after you do that, after you take into account the inventory and trade payable, remember the non-monetary items that are included in cost of sales. Okay? In this case, and usually, we have always depreciation. Always. We have amortization, and sometimes we may have gain or loss on sale of fixed asset. Make sure to include them there, okay? Any question? In case this is not clear yet, please ask me later so we can proceed with the preparation of the statement right now. So what we do, we are done with the first two items. I'm putting that in green, so that means that's check. We have already completed that. Gross profit, we do not take into account any profit measure. Why? Because gross profit is the difference between revenue and cost of sales, and we already took that into consideration, both revenue and the cost of sales. So let's continue with the distribution costs over here. In the direct method, I would say distribution costs if you see, I just added a word there, paid. That means that the part of the distribution cost that I have actually paid. Again, what is the equation or the formula that I need to use here? It would be distribution costs from the income statement plus distribution expenses payable at the opening, if they are, less distribution expenses payable closing balance. Now I'm just pretending they exist because actually we do not have anything that says distribution cost payable at the statement of financial position. So again, when I come here and I check the usually current liabilities section, we'll have that. If I carefully check there, I will find nothing that says distribution expenses payable. Okay? These accrued expenses over here are something else. We are not told that they are connected or related to the distribution costs. That means that when I come to the direct method over here, I see that the only item that I need to take into account is the distribution cost. So I say equal to minus, be careful to put the minus sign, minus 900, because this is a cash outflow. In other words, the distribution costs paid are equal to the distribution costs. Why is that? Because distribution costs payable at the opening and closing balances are 0, plus 0, plus 0. This is the balances that we may find in the statement of financial position. Is that clear? I took some time to clarify that. So again, distribution costs paid are only the amount of the distribution costs in the income statement. Why is that so? Because distribution costs payable, opening or closing, they are 0. They do not exist. So we have paid exactly the amount of expenditure during this period. The same thing exists about the next item. Remember over here, okay, check the distribution cost. The next line over here is administrative expenses. I have to convert that into a payment, into a cash outflow. So I go to the direct method and I write here administrative expenses paid. Okay, so I'm just adding a paid sign over there. Okay, how much are the administrative expenses paid? To make a long story short, as we do not have any administrative expenses payable in the beginning or in the ending balances, that means that the amount that we have paid is exactly the amount of the expenses during the period. That is exactly $2,300. So check if the administrative expenses have been taken into consideration and have been included in the cash flow statement. Any questions so far? So these items, both of them were pretty easy. The costs are equal to the amount of payments. Why? Because I have no liability at the opening or closing balances related to distribution costs or to administrative expenses. Okay, the next item that I need to take into account, okay, is this one here. So it is interest expenses paid. So interest expenses paid will be equal. Remember that additional information over here was saying that something about interest expenses. Let us see, yes. It says over here that the accrued expenses balance in the statement of financial position includes interest payable, 87,000 at the beginning of the period and 12,000 at the close as a closing balance. Okay, so we have to take that into account right now. Under the direct method, interest expenses paid will be equal with interest expenses plus opening balance of interest payable less closing balance of interest payable. Okay, that would be like the formula that we need to apply over here. Any question regarding the formula that we have included to calculate the interest expenses? Well, you can notice that it's somewhat the same thing that is being repeated all the time over and over again. Whenever we have to convert an expense to a related payment, we take the amount of the expenditure and we adjust that for the opening and closing balances, and usually we add the opening balance and we deduct the closing balance of the related liability in the statement of financial position. So it's almost the same thing that we need to do to all the items that we find in the income statement, and we take them in the direct method, and that therefore this name, we take that one by one. Okay, so let's calculate the interest expenses. That is equal with any questions so far? Okay, no. That is equal with the interest expenses over here, 45,000 plus 87 less, where do we find this amount? The opening balance is 87,000, the closing balance is 12,000. But be careful, as we need to add the minus signs. As we said, this is like the most common mistake maybe we can make sometimes. Now you see that even though the interest expenses were only 45, we have paid so much more because we have decreased by a considerable amount the interest payable. We find the opening balance 87,000 and we decrease that into 12,000. That means that we have paid all this accumulated liability over time. Okay, so this is interest expenses. Any question to that? We are coming to the end of the cash flows from operations. Okay, check, interest expenditure is taken into account. The last item over here that I need to take into account is the income tax expenses. So how to calculate for that, how to take that into account? That is taxes paid. Okay, this is what we need to calculate right now, taxes paid. Be careful, taxes paid will be equal to income tax expenditure plus opening balance taxes payable less closing balance of taxes payable. You see that the formula is exactly the same as in previous adjustments that we are doing, but please be careful because, as we mentioned, related to the taxes, we have two items. So the taxes are shown partly in the non-current liabilities, that is taxes payable into the long term, and part of them are included in the current liabilities as taxes payable in the short term. Okay, so we need to take both into consideration. Let's opening balance taxes payable. I'm also adding in the formula and tax and deferred tax. Less closing balance of taxes payable and deferred tax. I'm including in the formula the proper specific name so you will not be mistaken. So again, the taxes paid are equal to 140 plus the opening balances of both deferred taxes and income tax payable less the closing balances of both deferred taxes and income tax payable. Of course, this should be corrected with a minus. Why? Because this is a payment. It's a cash outflow. Okay, and we see that we are paying actually 200,000 in taxes. Again, formula is the same. Take the item of expenditure from the income statement and adjust for the opening and closing balances of the related items in statement of financial position. Be aware that sometimes more than one item will be related to an adjustment. Like, for example, calculating the payments to supplier, we based our calculations on inventory and trade payables, and taxes both have also two items, taxes payable and deferred taxes, which are actually long-term liabilities. Do we have anything take into consideration on the cash flows from operating activities? That is like the first section that we are completing in the cash flow statement. Okay, continue. Notice something else. Do you remember the accrued expenses over here? Okay, the balance is, opening balance is 172, and the closing balance is 107, and probably the accrued expenses have something to do with the operating section or operating activities. Now, part of the accrued expenses, including interest expense, okay, and the part of interest expenses that was included, 87 opening, and if you remember, it was 12 closing. I'm just writing like this in order to keep in mind right now that we will do the calculation. That means that the opening balance of interest expenses without accrued expenses without the interest expense will be 172 less 87, and that is 85. Okay, this is the the opening balance. Whereas the closing balance without the interest expenditure is 107 less 12, which is the interest. That means that the accrued expenses, except for the interest expense, have been increased from 85 to 95. Okay? Increase of a liability means a positive income or a positive cash flow in the income statement. So again, accrued expenses represent a liability, but inside of that, it is included also the interest, which is 87 in the opening balance and 12 in the closing balance. That means that without the interest expenditure, the opening balance is 785 and the closing balance is 95. We see an increase in this liability. But remember that whenever you have an increase in liability, this means more cash for the company. We have a cash inflow. And right here we can write increase in the accrued expenses. And in the brackets, I will calculate how we take into account the difference. Okay, closing balance, which is 107 less 12, less opening balance, which is, as we saw the calculations before, were 172 less 87. Sorry, the interest expenses. So this is how we take into account the increase in the accrued expenses, and that is 10, positive amount. That means that the cash flows from operating activities are equal to all of the above, and we can make the calculations over here. So we have a cash inflow from receipts from customers, and then we take into account all the payments done to third parties, like suppliers, like the state as well. Okay. And we can find out that the cash flows from operating activity is 692,000 because the amounts are in thousands. Any questions so far? We completed the most time-consuming section of preparing a cash flow statement, and that is the operating activities. Again, under the direct method, we take the items one by one. We should have less work to do in the second sections. Second and third. So the first section was cash flows from operating, and then secondly, cash flows from investing activities. Any questions so far before I proceed with the investing activities? have a look at the calculations of the different payments and receipts over here. Please do not forget anything. So we have an increase and shouldn't have, okay, let's see the question. An increase in liabilities shouldn't have a negative sign in the direct method. Not necessarily. An increase in liabilities usually or always means that we are not paying anything. That means that we should have a positive sign. That means this is cash inflow. So in the direct method, it will be, okay. So this is the accrued expenses that we should take into account. For some not very attentive eye, this could be something that maybe we forgot, okay? Because basically, and I would be pretty okay with you, because basically I told you, you know what, direct method focuses on the income statement and considers these changes over here, revenue and expenditure, one by one, and converts them to receipts and payments, okay? So we did that. We did that and we finished with the taxes paid. And we could very well finish here and proceed with the other sections, cash flows from investing and financing. But something that you should always do, have an eye on current assets and current liabilities. Both of them represent the operating activities. Not all the items in current assets and current liabilities are operating, but most of them are of operating nature. And that means that before you proceed, you take a note, you have a look there, and you see, did I really take into account everything there? So let's do that together, okay? Let's begin with the current assets. We have 3 items over here. Inventory, trade receivables, cash and cash equivalents. Okay, inventory, we took that into account when we converted cost of sales into payments to suppliers. Check. Trade receivables, okay, we took that into account when we calculated receipts from customers. Check. Cash and cash equivalents, okay, careful. This would be the total sum of cash flow statement. So of course this will be taken into account, but at the very end of our work. So regarding the current assets that are basically operating activities, everything is taken into account. I'm pretty sure I've not forgotten anything. So I continue with the current liabilities one by one. And I say, okay, trade payables, I included them when we converted cost of sales into payments to supplier. Check. What about income taxes? Good, we included income taxes when we calculated taxes paid. This is check as well. Now I come to the accrued expenses. This is aggregated amount. This does not represent an expenditure only. This is similar, if you remember the overheads that we explained in the inventory. Overheads included various kinds of expenditure. This is almost the same. Part of accrued expenses, I'm adding that as a new comment over here. Part of accrued expenses may be, for example, rent, maybe electricity, it may be interest. In this case, we have interest included there. And it may be transport, for example. I'm just assuming. So there are several items included there. Usually interest is part of the interest paid, and we already calculated that. Whereas these other items, rent, electricity, transport, they are obviously part of the operating activities, and I should include them somewhere in the direct method under the cash flows from operating activity. I don't know what exactly they are, but they have changed. And their change has an impact on cash. And this is what I'm interested for. Did I pay any cash or did I receive any cash related to this rent and so on that I mentioned? Let's check about that. The total amount of accrued expenses in the beginning is 172. But part of that we saw that is interest. Okay, do not change anything. I will undo this later. That means that without the interest, which is 87, the opening balance of the accrued expenses will be 85. This is the liabilities. I have to pay rent, insurance, transport, electricity, and so on. Whereas the closing balance, 107, actually is including 12,000, that is the interest. That means that the closing balance without the interest is 95. Again, this is a liability that I'm having over here, okay? Liability to pay rent, to pay other expenses. Now you see that except for the interest that is already taken out, the rest is increased from 85 to 95. That means that relating to this expenditure, and the expenditures are already included in cost of sales, we have not paid them in full. Actually, we have increased our liability. And the increase in liability means that I have not paid these expenses, means more money in for the company. And this is why the increase in the accrued expenses, also explained with the difference between closing balance and opening balance, like 10 that we calculated over here, is included in the cash flows from operation. I know it's a long explanation, but I really hope that was clear. Any questions? Any other question related to this part? What do you think if we have only 5 minutes break, and then after 5 minutes, we come back to complete this exercise, okay? Only 5 minutes break. In payments to suppliers, for example, what is included to receipts from customers, what does represent the depreciation, and so on. So please just try to make that really interesting and useful for your further studies and your future work, okay? So having said that, we spent our first hours trying to understand the situation better and also trying to calculate the cash flows from operations. That is like the 70 or 80% of our job is done already. Only the rest, very few transactions are included in investing and financing activities. As I told you, part of investing activities you will always find to be what has happened that has changed the structure of investment. That is, whatever has happened here in the property, plant, and equipment and development expenditure, I'm putting that in a lighter blue color, that will be included as cash flows from investing activities. Everything that has happened in here. Probably I have purchased new property, plant and equipment, and maybe I have sold some of them. I know that I sold some property, plant and equipment, and I have received some money, but maybe I also purchased some new one. And also the development expenditure, you see, it has changed from one year to the other. Remember that development expenditure is an intangible asset. It means payments that I've done, and this will have an impact on the cash flow statement. So let's go back to the direct method and let's see that maybe we have to list here purchases of property, plant and equipment. That is a cash outflow that most probably it will always be in every cash flow statement that you prepare. You will always have purchases of PPE. That is a very common item. You cannot escape that. And probably you have cash receipts from disposal of PPE. That is these investments that you may have done. And development expenditures paid during the period. Most probably these are the three items that will have caused cash inflows or outflows and have changed the investing structure during the period. Therefore, let's try to see, have we already made any purchases of the property, plant and equipment? Right here in this part, I will try to show the changes that have happened in the property, plant and equipment. I am pretty sure that you remember the equation that we have stated about property, plant and equipment. We said that property, plant and equipment opening balance plus increases less decreases for various reasons will be will be equal to the property, plant and equipment closing balance. Okay, so this is like a common logical formula that we need to express in exact terms right now. We start with opening balance of the property, plant and equipment, and then we add all the increases that have happened to the property, plant and equipment. Now, mention some kind of increases. Property, plant and equipment purchases of property, plant and equipment. This is what I'm trying to calculate. And I put that in red, so I know that this is what I'm trying to add and to find out over here. Any other change that may cause the increase in the property, plant and equipment? Property, plant and equipment. Any other change that may happen over here and cause the machinery, plant and equipment to increase? Remember our additional information, just not to forget that. Okay, look here. The non-current assets include property, plant and equipment revalued upwards. Okay, so this is another source of increase in the property, plant and equipment. Yeah, so we say there plus what? Revaluation. That would be another cause, another source of increases in property, plant and equipment. Any other cause? Remember one exercise that we solved in class. It was reclassifications of properties from one category to the other. But as far as we had to look at the additional information, that's why we take so much time getting familiarized and getting to know everything that's going on. When we saw this information, no transferring of property from one category to the other. So nothing like that, okay? This is the only reason why we have an increase in property, plant and equipment. We purchase new one or revalue what we already have. Less what? What are the decreases? Less depreciation. That is one common cause to have a decrease in the value of property, plant and equipment. Another cause would be in those cases when we have Not a revaluation upward, but a revaluation downward for property, plant, and equipment. But actually, in 1 year, I cannot have both. I either revalue upward or revalue downward. And this is 1 year when we have a revaluation upward. So no revaluation downward, no cause like that. Another common cause is a decrease in the value of property, plant, and equipment because property, plant, and equipment is sold. So less property, plant, and equipment sold. And so we may calculate the closing balance of the property, plant, and equipment. In this equation over here, dear students, we have everything, every piece of information. Oh, sorry about that. Okay, so in this equation over here, we have every missing piece of information except for the purchases. So we can find purchases in relation to the other stuff. So opening balance of property, plant, and equipment, I'm just trying to, the opening balance, I'm just trying to work with formulas in Excel. The opening balance of PPE, okay, is this one, 4,800. Purchases of property, plant, and equipment for me are unknown. A question mark over there. I'm trying to calculate that. How much are the revaluations? Now remember, the revaluation upwards are 125. Okay, I'm just writing that as a value because there is no Excel formula to support that. 125. Again, this is the revaluation of the PPEs during the year, okay? So let's continue. Okay, we have the depreciation expenditure, 700 less 720. This is the depreciation amount, okay? And this is a decrease, a factor that has caused the decrease in value of the PPEs. Good. How much is the PPE sold? Okay, let's check that piece of information. Oh, we have that there. The non-current assets disposed of during the year had a net book value of 75. This is the value in the accounting books of this piece of property that we sold right now, less 75. Okay, and how much is the closing balance of the property, plant, and equipment? That is 4,500. Okay, so the only piece of information missing over here is this one. How can we calculate? Using, again, the formula. That would be like 4,500 plus 1,025 plus all the decreases less, I guess, closing balance. So the amount that we have spent to pay for the purchases of the property, plant, and equipment are 370. Any question how we calculated that? Purchases of PPE, I will add that as a comment in this cell so you can have that as a reference later. Calculated as the difference between opening balance, closing balance, and other increases and decreases in property, plant, and equipment. Okay? It is calculated obviously as the missing formula, the missing part in this formula. Any question over there? Always use this formula, use this equation to calculate whatever you need to calculate out of the PPE. Sometimes you have the amount of purchases. Sometimes you need to calculate the depreciation amount. Sometimes you need to calculate the value of the property, plant, and equipment sold. So whatever you need to calculate out of here, always remember opening balance plus everything that adds to the amount of property, like purchases, revaluation, less anything that decreases their value, like depreciation or fair value decrease or property sold and so on, that is equal to the closing balance. Whatever you are missing among this information over here, please use this formula to calculate, okay? So even if it is only for this item, probably in the last exam you are not going to be required to prepare a full cash flow statement as I promised, but still you are going to be required to calculate 1, 2, or 3 items in the cash flow statement. Purchases of PPE, payments to supplier, who knows what it can be. So you have to know everything because it can be part of the exam. So purchases of PPE are equal, as we calculated them, with 370. That is a negative amount because we are spending money to pay property, plant, and equipment, okay? So again, we have calculated the purchases with this sign over here. So you can have that as a reference. I'm adding an asterisk to link every item with the respective calculations on the side of the cash flow financial statement. The other item that I need to add here is the cash receipts from disposal of PPE. That is quite easy because if you refer to the additional information, it is readily available that we have cash received on disposal equal to $98,000. That is, when we come to the direct method over here, we say that, okay, we received $98,000 out of selling existing property, plant, and equipment. Okay, we come at another item that needs some further clarifications, and I will use this space over here. Development expenditures during the year. How much did we pay for further development expenditure during this period? Now, following the same logical balance that we have here, we would say that development expenditure during the year will be equal to the opening balance of development expenditure. Remember that this is an intangible asset. It's non-current asset that doesn't have a material substance, is intangible, okay? So the opening balance of this development expenditure, of this capital expenditure, plus the development expenditure incurred during the year, for which I have paid during the year, less amortization during the year. Remember that as it is a non-current asset, a non-tangible one, it should be amortized during the year. And actually we have the amount of amortization. That should be equal to the closing balance of this item of development expenditure at the end of the period. So this is the equation, the formula that we are going to use to calculate the amount of development expenditure during the year. This is the unknown figure, the question mark figure for us, okay? Anyone can calculate that? Okay, it's not even. Remember that we are taking into consideration the purchases with a minus for cash flow statement purposes, but for the purposes of this formula, the the purchases are increases in value. So if you make that with a plus over here, I'm answering to Ivan, but also to the others. If you make 370 with a plus, because it is an increase in property, plant, and equipment, it will be 4,500. For these formulas only over here, remember that we are adding purchases. Why is it with a minus there? Because we are going to use that amount as a cash outflow in the cash flow statement. So again, the algebraic signs, pluses or minuses, are like the biggest source of confusion in cash flow statement. Keep in mind that we are calculating the purchases as an increase in the value, okay? So I have to consider that with a plus, but when I insert that amount in cash flow statement, I should put that with a minus. And that's why I use the formula in a certain way to give us the value in minus. Is that clear now for Ivan and for the others? Okay, thank you. So again, can any one of you calculate the amount of development expenditure during the year? It is pretty easy. Let me go back over there. The opening balance and closing balances, I'm just taking them from the statement of financial position. So the opening and the closing balances. What is the amount of the amortization? With a minus, as we said. Amortization during the year, let's remember, it is 80,000. So, okay, less 80,000, and then we can calculate the amount of development expenditure from the equation over here as 50. Again, the same explanation as I already tried to say to Ivan for his previous. Thank you, Sophia. That is great that you did that. Again, keep in mind the sign problem. Actually, the development expenditure is an increase in the value of this intangible asset, but we are calculating that in a way to have that with a minus sign, so it will be easier for us to incorporate right here in the investing activities. So equal with 15 with a minus. Okay. We are almost at the end. The cash flows from investing activities, you see that there is only 3 transactions, and that means that the cash flows from investing activities is the sum of what we have paid, with what we have received, with what we have paid for development expenditure, 322 with a minus. That is that we have a net cash outflow relating to financing activities. Very well, we are toward the end. Let's focus at the cash flows from financing activities again. This means that in the statement of financial position, I will get to focus in the equity section over here. I'm putting that with a light pink color. That is where I need to focus in order to take into account everything that probably has changed the financing structure. You see the share capital and the share premium, they have changed from one year to the other with an increase. And if I calculate the increases right now, I'm pretty sure that the increase in the share capital will be equal with what we already have calculated. You remember that we did some pre-calculations over here? And we did that so we could have the information when we needed them. So again, we have proceedings from issuing the shares equal to 1,050,000, but in thousands is 1,050. We come in the direct method. The first cash transaction is proceeds from issuing shares at a premium, that is at a price above the nominal value or par value. And the proceeds from issuing these shares was 1,050. Again, we have already made the calculations. If we didn't, we would go back right now about the changes in the share capital and so on. The changes in the revaluation reserve, as you see, we have an increase in the revaluation reserve from 300 to 425. That is something that we have already considered when we took into account the property, plant, and equipment. You see here the revaluation reserve increase. This is considered under investing activities, even though it is part of the equity section. So check also the revaluation reserve. Okay, let's see the retained earnings. This is something that we need to take into account in order to be properly sure that we are accounting for the dividend. You see the increase in the revaluation reserve. I'm just calculating that now. It is $15,000. Okay, we can check that the amount of the net profit for the year, 1,115, has resulted in the dividends paid 100,000, and the rest has been used to increase the value of the retained earnings. So again, check with your reasoning. The change in the retained earnings, it has been increased with 15,000. Is that okay? Does that reconcile or match the other things that have been going on? Listen to me carefully. We check the net income in the profit and loss statement. The profit for the year is 150, and this has been used for two different reasons. 100 I have used to pay dividends, and the other 15 is used to increase the retained earnings. Everything is okay. Nothing is wrong over there. So when I come to the direct method, under the financing activities, I may add dividends paid. And we have paid dividends equal to, don't forget the minus sign because this is a cash outflow. The dividends paid are equal to 100 or 100,000. Okay? Check also this information. Okay. You see the notes right now. We have two kinds of notes, a 10% and 5%. The 5% loans have no change there, so they have not changed. But we have a decrease in the 10% loan notes, and that means that we have paid. And actually, when we analyze the additional information, we calculated the repayment of the loan as being equal to 1 million, or in thousands, 1,000. So we come here and we say that repayment of loan in cash, using cash, is 1,000. Again, with a minus, because this represents a decrease in the loan account. The other loan item, no changes, so nothing to take into consideration there. Okay. The last item of the non-current liabilities, deferred taxes, we took that into account when we discussed the taxes paid, if you remember. So nothing to do there. We should not take that into account again. Otherwise, we would double the effect of taxes. Okay? So we go to the direct method and we are ready. This is, like we said in class, the moment of truth. Will the total of the cash flow statement be equal to the change of the cash and cash equivalents from the beginning to the end of the year? That would mean that we are correct in our calculations, or otherwise we would check for any mistake that maybe we have done. So the cash flows from financing is 50. Okay, let's continue with the last items of this statement. Cash balance, cash opening balance, net change in cash during the year. The net change in cash will be equal to the sum of cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So that means that the total sum of the cash flow statement is this one over here, net change in cash. The sum of the three items together, operating, investing, and financing. Does that comply with the change in cash? Let's see. Cash opening balance and cash closing balance. Both of them are referred to from the statement of financial position. Okay, let's have them with formulas. Statement of financial position. Okay, cash and cash equivalent at the beginning, and cash equivalent closing period. So this is the amount, change in cash position or in cash balance. Okay, let's see that. Closing less opening. So the change in cash balance, as you can see, is equal with the net change of cash during the year. If you remember the check figure that we incorporated, if we have a 0 over there, we are all right. If we have a 0 at the check figure, that means that the net change, the total of operation, investing and financing activities is equal to the change in cash balance from the statement of financial position. So this is the check figure. Okay, now that we prepared the direct method, do we have any question? Or we can continue with the indirect method. Any questions so far? Okay, can we continue with the indirect method? Remember that from direct to the indirect method, it's not that everything should be exactly different. We have many similarities between the two methods. And probably the biggest one is that the cash flows from investing and cash flows from financing will be the same. No need to prepare or recalculate every single transaction over there. What we need to do under the indirect method is to properly calculate the cash flows from operating activities, okay? We leave some blank spaces over there, and when we come at the cash flows from investing activities, we are free to just copy and paste from one method to the other because it's the same. Now, under the indirect method, the cash flows from operating activities will start with usually which item is that we start our calculations with. Usually we start with the net income, that is the performance statement, the profit and loss statement. We do not start with the beginning, the revenue item, but we usually start with a line of profit. It can either be profit for the year, but the IS 7 specifically requires that we start with profit before taxes. Okay? And to the profit before taxes, you can see over here, we can make several adjustments. The first adjustment is for the non-monetary expenses, and the other adjustment is for the changes in working capital items. Are we ready to start with the indirect method? So, indirect method, we start with profit before taxes and relating or referring to the income statement that is 255. The first kind of adjustment is adjustment for non-monetary expenses. Whatever that you have encountered during our discussion that is non-monetary, right now is going to be included over here. Who can remember several items that I can include under the first adjustment category? For example, depreciation is going to be included there. Another item to include is amortization of development expenditure, right? If you remember another item. Something else that you may want to add here, remember, is the gain on sale of fixed assets. Do you remember, or do you know, are you aware of any other item that is non-monetary expenses or income? Can you remember of anything else? Remember, you also have the change in valuation reserve, but as we previously said, the change in the revaluation reserve is part of other comprehensive income which are below the profit before taxes. Right now, we are trying to adjust or reverse the effects of non-monetary items that are included in the profit before taxes. So this is like the three that we can use over there. Any other that we can include? Okay, so the depreciation is 720, if you remember. The amortization is equal to 80, and the gain on sale of its assets is equal to 23. remember that gain should be deducted over here because of the reason it is an income. It has been included with a plus signs in profit before taxes, but right now it should be deducted to reverse its effects, okay? So remember something else that we need to take into account. As we started with profit before taxes, and we have to add the interest paid later, we have to also annul the effect of the interest expenditure. So something else that we need to include here is the interest expenses. So the interest expenses that I will include later are 45,000. They are deducted from the profit before taxes. I have to add them back, not because they are non-monetary expenses, but because I will include them later. Actually, it would be more appropriate to include them here, and I would say plus interest expenses 45. Why? Because they are to be included as a certain item by the end or by the bottom of the cash flows from operations. Okay, questions? Yes, Sophia. Thank you very much. Actually, we should have added that before, and I really got that 1 minute after you wrote. Thank you very much for paying attention to this. Now, after we apply the adjustments for non-monetary items, what we have over here is operating profit, if you can call it like that, before adjustments in working capital items. Even if you don't remember the name over here that I just wrote, it's okay. I'm not charging you with being guilty that you don't remember this long name, operating profit before adjustments in working capital items. But still, let's calculate what we have here. We had interest back because we are going to take that into account later. We had the depreciation to reverse its effect because it's non-monetary. We had the amortization with the same argument, and we deduct the gain on sale because it has been already included with a plus. And then the second kind of adjustment that we apply to the indirect method is the change in working capital items. Now, what are working capital items, guys? Working capital items are items in the current assets and current liabilities that affect the operating activity. So again, working capital items, maybe I have to write that there in a note. Working capital items are items part of current assets and current liabilities that affect, so not everything that is under current assets and current liabilities, but only those items that have an effect, an impact or affect the operating activities, okay? So we should pay attention right now. We should pay attention to the section of the current assets and current liabilities, and whatever has changed there, and I'm using probably a light green color to denote the fact that it's different from the other sections that have the impact in investing or financing activities. Whatever change there has their impact in the working capital item. Inventory and trade receivables, indefinitely, undoubtedly, they are part of working capital items. So I will, first of all, I will say here increase in inventory. Remember that the increase in inventory is going to be considered or taken into account with a minus sign. Again, why? Because increase in inventory means less cash for us. So increase in inventory is going to be taken into account with a minus sign, just to be sure that we do not make mistakes with signs, okay? So what about trade receivables? Again, we have an increase in trade receivables. Again, we will have the same impact, increase in accounts receivable or in trade receivable will have a negative impact. Again, let's put the minus before and calculate the change in trade receivables. That means an increase will have a negative impact for the cash of the company. Okay, so again, we are focusing in the statement of financial position under the current assets and current liability and check if those items relate to the operating activities. Inventory and account receivable, yes, they have their impact in the operating activity. What about the current liabilities right here? Okay, this section, light green color again, because it has an impact on probably on the operating activity. Trade payables, yes, definitely they impact the working capital items. The trade payables have been increased, and an increase in the liabilities means a positive effect for the cash of the company. So we have increase in accounts payable, and as we said, that has a positive impact for the company. Any questions so far? Should we repeat something so far that we have discussed the changes in the working capital items? Okay, let's go on. So trade payables are part of operating. Income taxes, yes, they are, but they are going to be calculated a little bit later as taxes paid. The same thing with interest expenses paid a little bit later, but again, remember the increase in the accrued expenses right now, that is also to be included over here. Increase in accrued expenses. Remember that it was 10. I'm not repeating the same idea and arguments again. So that is all the effects in the working capital items. Again, remember that we took line by line the current assets and current liabilities items and made sure that they had an impact on the operating activities. And we identified these 4 items over there. So what we have right now is cash generated from operations. Be aware, it's not the cash flows from operations yet. Still, we have to take into account the payments for interest and taxes. But the cash generated from operations right now is equal to the operating profit before adjustments in working capital items plus all the effects that we calculated as changes in the current assets and current liabilities having an impact in operating activity. Any questions so far? Now, from this moment on, everything becomes very easy. I have to deduct, or I have to say here, less taxes paid. And then we have to say less interest paid. Actually, it should be the other way around, another order. We first subtract the interest because they are above the taxes in the income statement, and then we subtract the taxes. If I didn't prepare the direct method, I would do the same calculation as in that method, but luckily, we have already calculated both interest expenses paid and taxes paid. And when I come to the indirect method, I just refer to the amount that I had already calculated in the previous method. So, as I promised, things will become easier right now. So, we have finally calculated the cash flows from operating activities. Remember, the CFO should be equal to that calculated under the direct method. So, both methods, direct method and indirect method, should give us the same amount of cash flows from operating activities. Well, let's see about that. The cash flows generated from operations, 1012, less the interest paid, less taxes paid, that we already calculated before, we see that the cash flows from operating activities is 692. Let's check. The direct method was giving us the same exact answer. So 692 and also 692 under the indirect method. Again, the two methods differ only partially between each other. They do not have everything different. They just are different and change regarding the way that we follow to calculate for the cash flows from operations. But actually the amount of CFO is the same under both methods. Any need there to repeat anything, or we can continue? Okay, do you need us to repeat any calculation, something that we may explain again before we continue? For anyone? Is that clear to everybody? So again, we are talking about the indirect method. That is that we start from profit before taxes, and we have to exclude first. We have to exclude the interest expenses. Why is that so? Because remember, under both methods, the interest expenditure and the taxes are going to be included by the bottom of the cash flows from operations. Why? Why should I do that? Remember the discussion under IS 7? Both interest and taxes could be part of other sections. Interest paid could be part of the cash flows from financing activities, and taxes could be part of investing, for example. And as they both could be part of other sections, it is better to show them at the very bottom part of the cash generated from operations. Think about anything that maybe you need to ask, and I'm back for one. I really apologize about that. I had to open the door for a colleague of mine here in office. So what I was saying is that under the indirect method, we start the calculations in a different way, but we arrive at the same result over here. So the same amount of cash flows from operating activities. We start from profit before taxes as it is being declared and reported in the income statement. And first of all, we exclude interest expenses, okay? Okay, finally we have a question in the chat. It's better than repeating myself over and over again. Okay? First of all, Ivan is asking that in order to prepare cash flows, we always have to go through all the elements in balance sheet and income statement and see what affect cash. Basically, that is right. So whatever the cash flow statement means is that even though you are not required to prepare a full statement, for every item that you will be required, you have to be very attentive where that item is to be found in the profit and loss statement and in the statement of financial position. So, for example, assume that you are required to calculate the cash receipts from customers. You know that the cash receipts from customers relate to 1. Revenue in the income statement, and 2. Account receivable in the statement of financial position. So you implement them together, you relate them in the formula under the direct method over here that we mentioned, and in this way you have calculated the receipts from customers. So whenever that is correct, just to make sure we understood, whenever you are required to prepare cash flows, you have to connect and link information together from the other two financial statements. Adela, don't worry about that. Almost always you will include the interest expense. So for the purposes of our exercises and problems, interest expenses will always be regarded as cash flows from operations. But that is just to make you aware that if you prepare the work in your groups and you find a part of cash flows from financing, if you find somewhere there that you have some interest paid, don't be surprised. Interest paid can be included in the cash flows from financing, and the company decides which part of the interest will be included in financing activities. We didn't have time to go through today, but the other illustration 11, that I will send as a solved exercise later, has as one consideration that relates to the leases. Leases are having an effect in the interest, and probably one company may select or may choose that part of the interest expenses that are related to the leases, it could be reported under the financing activity. But for the purposes of exam, don't worry about that. You will always be including that in the cash flows from operations. In reality, companies may include in the financing section some part of the interest as they deem more appropriate. They know their company better and they know which part of the interest is more finance related. Okay, thank you, Adela. So again, have a look at the both method, direct method and indirect method, and you see that we have two adjustments. The first one is for non-monetary expenses. Whatever comes into your mind, provisions, provisions, depreciation, amortization, gain, loss on sale of fixed assets, provisions if you have, I mentioned that, you will include there with the contrary sign that you have already included in the profit. For example, if the depreciation is deducted in the profits, here it will be added back. And then you focus on the changes in working capital items. Basically, what you do there is that you go back to the statement of financial position, current assets and current liabilities, and you see if you have a change there in an item that logically is linked and related to the operating activities, you put the change there. If it is an increase in operating assets, it will be with a minus. A decrease in operating assets with a plus. And vice versa, if you have an increase in a liability, it would be with a plus, and a decrease in liability will be with a minus, because it means that we are paying money, we are using our resources. Then you take cash generated from operations. This is not cash flows from operations yet, because the last two items are interest and taxes paid. How we came up with those amounts is already disclosed in the direct method over here. You have all the necessary calculations with formulas in the direct method. Whereas, regarding the other two sections, nothing to worry, because everything is exactly the same as under the direct method. So whatever I'm going to do here, don't get tired again. We have this ready because we have already done the necessary calculations in the direct method, and we see that everything goes perfectly in line. Again, direct and indirect, they do not have everything different. The only different thing is the approach they follow to calculate the cash flows from operations. Exactly the amount of cash flows from operations will be the same, and the whole sections of cash flows from investing and financing will also be the same between the two methods. And also something else that we need to say is that we have to correct now the formulas, right? Okay, so this is cash flows from financing minus 50. And right now we need to also insert the opening and closing balances, because we copied the information without copying the formulas. Okay, in order to have everything good when we post this solution online. So again, the solution of illustration 10 will be posted on Moodle, but also the solution of illustration 11 will be posted on Moodle. Repeat the treatment of provision. Yes, I will do that. As I was saying, the illustration 11 that we couldn't solve today together, will be posted on Moodle nevertheless, so you can have that. About the treatment of provision, in case you have a provision, for example, provision for warranties or provision for court expenses or provision for increases in the bad debts and collectible amounts of trade receivables, the provision will be added as a non-monetary expense over here. So it will be plus provisions. Anytime you have provisions, you will include there, okay, as an increase or with a positive sign, because provisions are non-monetary expenses, as you know. So anytime you read you have provisions, you have to include the increase in provision. Careful, the increase in provision you have to include under the non-monetary items, okay? Any other question? Okay. Yes, Ivan, I mentioned this morning that probably tomorrow I will upload the exam of previous years. Not this afternoon, because I have to upload all what we did today, but tomorrow I'll make sure that you have access to the exams of previous years and also to their solutions. Okay? Any other thing that I can help you with? Tomorrow is an off day, so we'll not have lecture tomorrow, we'll not have tutorial, and we'll see each other on Wednesday with a new chapter. We'll start the financial analysis together with the ratios, how to calculate the ratios and how to interpret them. So I think that starting from Wednesday, we will have a very beautiful part of our lecture. The technical stuff is almost over. We are going to learn new things that are really very interesting and are not very difficult, but apply very much to the logic that you have. Okay? So thank you for your attention. I say goodbye to you and see you the day after tomorrow. See you on Wednesday. Bye.